This video presentation is about an essential part of all commercial operations as it facilitates litigible insight into the health and capacity of the organization in the future. So today, we're going to talk about financial analysis and its subtopics. So the financial analysis subtopics are financial analysis terms and definition, interpretation of ratios, sources of data, cash flow statement, and non-cash transaction. So the learners will be able to accomplish in this topic is to know the importance of financial analysis for applying loans and credit, to know the interpretation and limitation of financial ratios, to understand the computation of financial ratios and its formula, to explain funds flow statement and sources of data, to analyze cash flow statement and non-cash transaction. But first, I will introduce myself. I'm Sophie Alalong and I will tackle about financial analysis, terms, and definition. So what is financial analysis? Financial analysis is the process of evaluating businesses, projects, budgets, and other finance-related transactions to determine their performance and suitability. Typically, financial analysis is used to analyze whether an entity is stable, solvent, liquid, or profitable enough to warrant a monetary investment. So, ang financial analysis, nagbase na siya sa financial statement. Ginestadihan o gina-evaluate na siya sa mga analyst para mahibalaan ang stability and profitability sa isa ka business. Kung pwede ba sila magpautang or mag-warrant og monetary investment nga mga dagko nga mga kwarta. Example, creditor. The creditor used financial analysis to evaluate and study the debtor capability to pay their debts. Banks. Before they consider a large loan amount to their first-time customer, they devote a great deal more time and care to their analysis. So, ayaha mo consider ang bangko og large loans, tanawon sa nila ang financial analysis sa ilang customer, labi na og first time pa niya mag-loan sa ilang bangko. Just in case alanganin ang financial data sa ilang customer, ug para makabayad siya sa iyang giloan, ang bangko usually mangayo sila og collateral such as house and lot property. Just in case ang nangutang dili kabayad, they will foreclose the property that the debtor submitted. The nature of the analysis and the degree of conclusiveness of the results depend much on the amount and quality of the data available. It is important that all the required financial and other data be organized properly. For this purpose, the following standard form have been designed. A. Financial Statement Highlights. This form is generally prepared for all clients of the bank, whether new or old, for a particular type of business or industry. The period should cover the past 5 years of its operation. The time frame covered in analyzing the past performance of a company enterprise should be the previous 5 years of its activity. However, for organizations that have been in operation for less than 5 years, the same should apply from the beginning of operations to the time of analysis. So, why the period should cover the past 5 years of its operation? Kay dinhan nila makita within 5 years kung ni-increase ba ang ilang profit or ni-loss. Og bisan less than 5 years ang pag-operate, same na Japon ang pag-analyze sa ilang financial data. So, the form for current or projected performance should be prepared quarterly or semi-annually if the financial statements are available, thereby providing the analyst with the latest available statistics which will help improve the accuracy of his forecast. Second, financial ratios. Ratios are used to express the relationship of one variable to another. Such ratios are measures used in appraising financial condition, operating efficiency, and profitability of a business concern. To a certain extent, the analysis of ratios provide guides and clues in spotting trends toward better or poorer performance as well as significant deviations from the average or standard gauge. Financial ratios furnish reasonable answers to specific questions posed by problems which are of interest to the financial manager, creditor, or investor. So, ang financial ratio is one of the analytical tools that finance managers and analysts use to measure how financially healthy a company is. It involves the use of numerical values taken from both income statement and balance sheet. That's why it's very important for us to become familiar with the statement of operations.
Good morning, sir. I am Mary Grace Dagasuan, and I am the second reporter, and my topic is interpretation of ratios. By itself, a ratio has a little significance unless ratios are ranged against appropriate measuring disease or standards of comparison. The analyst cannot determine whether they indicate favorable or unfavorable conditions. The most common standards used in ratio analysis are: first, mental standards of the analyst. This pertains to the general conception of analyst of what is normal or adequate form on the basis of his personal experience and observation. 2. Absolute standards recognized as desirable regardless of the type of company, the time, stage of business cycle, or the objectives of the analyst. Ang absolute standards ay isang mahusay na paraan for a company upang masukat ang pag-unlad at kahusayan nito. Ang paglalagay ng zero defects o losses na layunin para sa kupunan nito, halimbawa, maaring magpatupad ang isang manufacturer ng zero defects standard bilang bahagi ng quality control nito upang matiyak na kumpleto at walang mga diepekto ang mga produktong ginagawa nito at ipapadala sa mga retailer. Third, past performance. This applies to the record of past financial and reporting performance of individual businesses. A key area of a corporate financial analysis involves exploring a company's past performance, such as net earnings or profit margin, into an statement of the company's future performance. This type of historical trend analysis is beneficial to identify seasonal trends. For example, the retailers may see a drastic upswing in sales in the few months leading up to Christmas. This allows the business to forecast budgets and make decisions, such as necessary minimum inventory levels based on the past trends. Fourth, selected competing companies. The ratios and percentage of selected competing companies must be taken into account with special reference on the most progressive and successful ones. All businesses have competition, and knowing yours is key for innovating your products, services, and marketing strategies. But identifying the competition isn't always obvious. Some are direct while others may take more time to uncover. Fifth, plan or budgeted standards. Developed through the use of data in the budget. They are sometimes called goal industry. Example, every project boils down to money. If you had bigger budget, you could probably get more people to do your project more quickly and deliver more. That's why no project plan is complete until you come up with the budget. And the last one is industry average or medium. It refers to the average arithmetic or median ratio of the members of the same industry. Industry average ratios are summarized measure of companies' financial performance in form of collection of data. Usually, financial ratio form a various type of business that offers different products and services. Every industry is unique to some degree, but some general characteristics help to predict the likelihood that new entrants will join industry. For example, to the extent that existing competitors enjoy economies of scale because new entrants struggle to match incumbents' prices. Limitation of financial ratios. In spite of the merits of financial ratios, a number of limitations are observed from its use. Among them are companies use different accounting methods which thereby seriously impair the comparability of many situations even within the same industry. B. The variability of product mix, geographic location, corporate objectives, and of most other conditions under which a business operates usually accounts for the lack of comparability. Kung mag-produce tag business, kailangan stable atong financial sa mga products, location objectives para sa atong i-build na business. That's all. Thank you.
Morning, sir. I am Dino Pinawaro and I am going to talk about computation of financial ratios. In computing a financial ratios, average balance sheets figures are only used when solving for interstatement ratios, involving figures from both the income and balance sheets. Average means arithmetic average when it is computed as a following: beginning balance plus ending balance divide 2. The formulas and general interpretation of financial ratios are indicates on the table below. Liquidity and solvency ratios. Ratios current ratios formula. Current asset divided by current liabilities. Truly indicates the borrower's ability to meet his obligations. Quick ratios formula: cash plus marketable securities plus receivable divided by current liabilities. Supplement the current ratios and it is a more severe test since it is considered only on the quick or relatively liquid assets. Receivable turnovers formula: net sales divided by gross accounts receivable. Represent a variable test of the callability and currency of a receive also an excellence check on the current ratio. Average collection period formula: average current receivable divided by sales times 365. Average collection period: true measure of the overall quality of the account receivable and of the credits policies of a business. Should compare with terms of sales of the business. Current liabilities equity ratios formula: current liabilities divided by total stockholders equity long-term debt ratio. Formula: current standard long-term debt divided by total stockholders equity debt ratios. Formula: total liabilities divided by stockholders equity. Current liabilities equity ratios measure the degree of protection sheets of terms creditors provided by the owner's operation efficiency ratios. Gross profit margin formula: net sales minus cost of goods sold divided by net sales. Gross profit margin indicates the margin to cover operating total expenses, taxes, and net income. Operating expense divided by net sales. Formula: net operating income divided by net sales net profit margin. Formula: net income divided by net sales. Operating expense divided by net sales. Reflect the ability of a management to adjust, explain to changing sales conditions. Net working capital, turnovers, formula. Net sales divided by current asset, current liabilities. Net sales working capital turnovers test the efficiency with which net working capital is utilized. Shows the number of peso of net sales business has obtained for each peso of net working capital. Not financial by current creditors. Average age of investors formula. Investors times 365 of cost goods sold. Average age of investors estimated the average of numbers of days that the goods and investors are in hand. Investor turnovers formula. Cost of goods sold divided by average turnovers. Investors turnovers. Variable merchandise efficiency and investors quality reflect the amount of a working capital laid up in investors. Average operation assets turnover. Formula. Net sales divided by average operation assets. Average operating asset turnover measure of the use made of operating assets. True indicates of a tendency towards overestimated in operating assets. Average total assets turnovers. Formula. Net sales divided by average of total assets. Average of total assets turnovers measure the degree of investment in total assets in relationship to their general of sales. Profitability ratios. Ratios turnover average operating assets. Formula. Operating income divided by average operating assets. Return on a total average assets. Formula. Net income divided by average of total assets turn on average stakeholders equity. Formula. Net income divided by average of stakeholders equity. Cost of debit formula. Interest change divided by average of long-term debit. Earning per sheets. Adjustment formula. Net income available to common stock divided by outstanding number of shares of base year book value per common shares formula. Common equity plus surplus assignment to common divided by number of the common share outstanding. Market date ratio. Cash divided per common shares united adjustment. Formula. Cash divided by and declare the equivalent of one share of stock as of year ends. Cash divided per share adjust. Formula. The average formula adjusted for stock dividend payout rate. Formula. Cash divided by per share divided by earn per share. Cash divided year. Formula. Cash divided per share divided by average per market price earned yield. Formula. Earning per share divided by average market price. PE multiplied formula. Adjustment market price adjusted earned per share.
Have a blessed morning to our respected instructor, Sir FG, and also to my energetic group mates. By the way, I am Joymi Baracal. In today's video, I am going to tackle about funds flow statement. So, funds flow statement describes the sources of funds and the uses that have been made of them during an accounting period. It's not restricted to the flow of cash. It summarizes the sources of all working capital items as well as their applications. The recurring circulation of funds among the individual current assets and liability accounts are considered part of a wider funds movement. In this part, the funds flow statement is broader in the scope than a cash flow statement. So, taas og scope ang funds flow statement. Ang funds flow statement, nag-focus siya sa circulation sa pondo like current assets and liability account nga nag-consider na wider funds movement siya. Gakalculate pod siya sa deduction of interest, income, and gains on asset sales gikan sa net income for the period and adding interest expense, depreciation, and losses on asset sales. So, in this moment, we will going to discuss the cash flow statement. Summarizes the movements of cash in and cash out of the business. It shows the sources of cash receipts and the nature of cash disbursement. But I will not go deeper about cash flow statement because later on, Mr. R.G. Mollett will discuss it. And now, the difference between funds flow statement and cash flow statement are: funds flow statement analyze for a year, a month, a week, or any other period will show where management has decided to commit funds, which is the uses, to reduce investment, which is sources, to acquire additional funds, which is sources also, or where to reduce claims against the firm by giving up funds in payment, which is uses. Who uses the funds flow statements? Of course, the lenders of funds want to know the company's health before investing it. The funds flow statement would be of a significant area of interest since they assess the utilization of funds rather than focusing on the operational losses or profits declared a company's financial statements. Example of this is bankers who utilize the funds flow statement to assist the company's overdraft and cash credit facilities.
Good morning, sir. I am Russell Ryan. I am going to discuss about sources of data. Sources of data figures from the fund flow statement are derived from the income statement and the comparative balance sheets. The three main sources of data for a financial analysis are a company's balance sheet, income statement, and cash flow statement. The following items can be derived from the income statement: a net operating income and net non-operating income, non-cash charges to income. Net operating income, or NOI for short, is a formula used in real estate used to quickly calculate profitability of a particular investment. Net operating income determines the revenue and profitability of invested real estate property after subtracting necessary operating expenses. Ang net operating income, it means that para sa maikli ay isang formula na ginagamit sa real estate upang mabilis na makakuha ang kakayahang kumita ng isang particular na pamumuhunan. Tinutukoy ng net operating income ang kita at kakayahang kumita ng namuhunan na ari-arian ng real estate pagkatapos ibawas ang mga kinakailangang gastos sa pagpapatakbo. Example of net operating income. This can be viewed as the rate of return on a property you purchase in all cash. Net non-operating income is the portion of an organization income that is derived from activities not related to its core business operations. It can include items such as dividend income, profits or losses from the investments, as well as gains or losses incurred by foreign exchange and assets writes down. Ang kita na hindi nagpapatakbo ay ang bahagi ng kita ng isang organisasyon na nagmula sa mga aktibidad na hindi nauugnay sa mga pangunahing operasyon ng negosyo nito. Maaari itong magsama ng mga item gaya ng kita ng dividendo, kita o pagkalugi mula sa mga pamumuhunan, pati na rin ang mga pakinabang o pagkalugi na natamo ng foreign exchange at mga pagwawalang bahala ng asset. Examples of non-operating income include dividend income, asset impairment losses, gains and losses on investments, and gains and losses on foreign exchange transactions. Non-cash charges to income is a write-down or accounting expense that does not involve a cash payment. Depreciation, amortization, depletion, stock-based compensation, and asset impairments are common non-cash charges that reduce earnings but not cash flows. It means that ay isang write-down o accounting na gastos na hindi kasama ang cash na pagbabayad. Ang depreciation, amortization, depletion, stock-based compensation at asset impairments ay karaniwang mga non-cash charge na nagpapababa sa mga kita ngunit hindi sa mga cash flow. Example, non-cash expense are those expenses that are recorded in the income statement but do not involve an actual cash transaction. A common example of non-cash expense is depreciation, when the amount of depreciation is debited in the income statement. The amount of net profit is lowered yet there is no cash flow.
So good morning everyone. I am RG Hamid Tumulit, a student from BSBE 3E. And today I will be reporting about the topic given to me entitled cash flow statement. So first, what is cash flow statement? So cash flow statement. The cash flow statement shows the movement of cash in like depositing money, and cash out of the business, cash out like withdrawals. By listing the cash source, receipt, makita or makuha pod nila pamaagi sa mga resibo. Under uses disbursement, og sa ilahang mga gipang bayaran. Ana. It also furnishes a basis for estimating future cash needs and pointing out the probable sources to meet these needs. Og source pod niya aron ma-estimate ang future cash nga gikinahanglan para pod may bal-an ang mga uban pa nga mga sources para makuha ni nga mga kinahanglanon. A projected cash flow statement is prepared for other purposes, such as for first, investment research to ascertain available cash for dividend payments. So sa investment research, mao ni nga time na ang mga investor mag-study para ma-analyze kung nitaas ba or niubos ba ang performance sa ilang financial asset. O aron pod nga maplastar kung maayo ba ang dagan. So the second one is credit analysis. Credit analysis to determine the ability to a prospective client to repay the principal amount and interest on loans being applied for. Diri para mabalaan kung unsang abilidad sa mga clients para mabayaran nila utro ang principal ug interest sa loan nga ilang gisudlan. So ang ikatulo, si others, for other purposes like determining prospective bank's clients. So the figures needed to accomplish the cash flow statement are derived from the following sources. So the first one is historical or projected income statement. The projected income statement is the snapshot of your forecasted sales, cost of sales, and expenses. For existing companies, the projected income statement should be for the 12-month period from the end of the latest business year-end and compared to your previous result. So, and the second one, historical or projected balance sheet. Projected balance sheet or pro forma balance sheet are the statement that shows estimated changes to a company's financial status, including investment, other assets, liabilities, and financing for equity. The third one reports on company expansion program and other activities. And lastly, internal sources. So, there is a ratio like average collection period and the average payment period are important in determining the timing of cash inflows and outflows. So, ang average collection period, it is the average number of days it takes a business to collect and convert its account receivable into cash. It is one of the 6 main calculations used to determine short-term liquidity, that is, the ability of a company to pay its bills, current liabilities as they come due. And ang average payment period is refers to the average time period taken by an organization for paying of its dues with respect to purchases of materials that are both on credit basis from suppliers of the company. And the same doesn't necessarily have any impact on the company's working capital.
Alright, let's proceed to the last subtopic, which is non-cash transaction. So, non-cash transactions are costs that do not involve cash in the transaction. The word expense usually refers to any cost or loss of funds that a company incurs in the course of its operations. Many businesses compile income statements that list their income and expenses over a length of time. So, non-cash transactions often appear as costs in the income statement, but they differ from other expenses. It is necessary to eliminate the effect of transactions that do not involve a source or use of cash. Such transactions include A. Recognition of depreciation and amortization. B. Recording of uncollectible receivables expense. And C. Write-off of worthless receivables. D. Declaration and issuance of stock dividends. A. Appropriations of retained earnings. F. Appreciation of non-current assets. And lastly, write-off or reduction of the book value of non-current assets. And more last, recording disposition of partially or fully depreciated plant, property, and equipment. For example, a common example of cash expense is depreciation. When the amount of depreciation is debited in the income statement, the amount of net profit is lowered, yet there is no cash flow. Okay? Example of non-cash items include deferred income tax, write-downs in the value of acquired companies, employee stock-based compensation, as well as depreciation and amortization. At nagpapahiwatig rin ito na ang isang non-cash na transaction ay isang kontrata, negosyo o kaganapang pang-ekonomiya kung saan ang isang kumpanya ay hindi nagbibigay ng anumang halaga ng pera. Okay? Non-cash transaction ay ang mga non-cash transaction, lalo na ang mga nauugnay sa mga gastos sa pagpapatakbo ng isang kumpanya ay dumadaloy sa isang pahayag ng kita at pagkawala. Okay? At ang tinatawag ng mga accountant na isang ulat na nagpapakita ng mga kita ng kumpanya, gastos at nitong kita o nitong pagkawala kung ang mga gastos ay lumampas sa mga kita. So, loss na siya. Once again, join me, Boyar Cal, signing off. Have a blessed day ahead. Thank you.
In this topic, we learned that financial analysis is the critical part of business operations. Cash flow statements allows a business to plan for the future, taking into account operating expenses and the company's past performance. The financial health of the company depends on an analyst understanding the money flow. Second, the most important financial statement for the majority of users is like to be the income statement, since it reveals the ability of a business to operate a profit. Third, a proper analysis of these statements provides valuable insight into the financial condition and operations of a business. Such analysis is important to all who have an interest in the functioning of the business. Among those who are most directly concerned with the various tools of analysis, who use them most are keenly aware of their need and importance are business executives, bankers, investors, and credit managers. So, this concludes the focus of discussion today. To end, thank you so much for your interest and attention. Once again, good morning.